All right, guys. We're not gonna do the intro today. We're gonna go right into it because I don't want to miss out. Pulling everything up. To let you guys know that I'm live. Ritesh, how you doing, my friend? Sorry, this is a little bit spontaneous, but I figured we watch this live. Misa, how you doing, my friend? Good to see you. I'm gonna pull up Jerome Powell here in a second. All right, let me turn off the music.
You will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a quarter percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings.
Oh, Pratish, happy late birthday, my friend.
We'll take a data-dependent approach in determining the
That's funny because Monk's birthday was yesterday too.
May be appropriate.
Happy late
more
birthday.
To say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite
yeah, sorry guys, I literally had to run out of the house quick.
Activity in the housing sector
and grab some. Well, I didn't even grab. I was supposed to grab some meat, but I didn't even wasn't even able to grab some to eat.
Rates and slower output growth
The things I do for you guys.
Weighing on business fixed investment.
I'm gonna eat after this, but I'll be quiet.
The labor market remains very tough.
Everyone, wish Pratish a
job gains
happy birthday. I want to see happy birthdays in chat.
Per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged
How's the volume, guys? Good?
Years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides.
Let's go. Let's dump.
And we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate.
Biden's party running out of money. Why Fed doesn't support it now, like it did with Trump.
People on the committee have different
that's
forecasts.
Valid. That's very valid, Vlad.
Most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
I hate press, either dumb or paid. Yep, that is absolutely true, Vlad.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff.
I was waiting for it. I was waiting for the Gina comment.
Do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff?
FPK Nisma, how you doing, my friend?
I wouldn't.
No,
say
you're
that it
just
did. It was,
you're
of course,
just
it's
on
something
time,
that
man.
came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Oh, thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks. And
What, Vlad?
lots of data. And there was one page on Silicon Valley Bank, which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about
Way the U.S. is paying their bills.
the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity. And you asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial
Call me
stability
very
tools
selective,
to
my
support
partners, yeah.
banks through our lending facilities. And at the
Beta
same
bot.
time, we've been able to.
I got sick
use our
today. No
monetary
worries, my friend.
policy
We're just
tools to
here
foster maximum
hanging out,
employment and
watching
price stability.
Jay Powell speak, see how the markets react.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention.
No worries,
I think
Beta.
that
Thank you
was
so much
also
for
in the
stopping by.
presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Go to Victoria.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap.
Entered a
for
Solana
failing
scalp
bank.
short. I think I was wrong.
So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I
don't know
think
about
it's
that one,
probably
Jeff.
good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one. meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And
Anybody else
I would just say
watching
that the
I can
SLUICE
check- I
is
can-
broadly
check
consistent when
on
you
it.
see it with how we and others have been thinking about the situation and what we're seeing from other sources.
Oh.
You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the
DXY.
second half of last year.
Put a nice little dump.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they
That's a good question,
they
Joe.
both matter equally at that point.
I really
Right
have
now
no
you
idea.
have a
If they
labor
just
market
keep
that's
raising
still
interest rates,
extraordinarily tight.
obviously
You've
there's
still
going to be a
got
lot of
1.6
backlash that
job
comes to that.
openings, even with the
It
low
just
job
doesn't.
openings number
I just
for
don't
every
see how.
unemployed person.
I agree. I don't know.
We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down. And that's a good sign, down to more sustainable levels. So I think it's still possible. I think, the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others. And you can look at
Coyote, how you doing, my friend?
What they would have to run at
Thanks for
over a
stopping
long
by.
period of time.
Finally,
for
good
that to be
question.
consistent
Finally,
with
recession
2%
talk.
inflation.
Yeah,
They can
I definitely.
deviate. Corporate margins
Definitely some
can
good
go
questions.
up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
U.S. oil looking kind of
Michael
bad.
McKee
There's a
from
couple
Bloomberg
potential for
Radio
longs.
and television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming
Joe.
data, which is by definition backward-looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Sorry. Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of, of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing, we don't think now. It hasn't actually been growing. It moved up, moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process.
Come on, DXY's pumping.
Quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Come on.
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release?
Basically 0.25 raises till Powell was happy. Yeah, pretty much.
I didn't take part in creating the report or doing
I'll give you
the
my
work,
thoughts
but
at the end of it.
I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that is, it may just have been technology evolving, you know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about is, and I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, you know, with what you saw in the beige book, and you will see in the sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system.
Oh, Joe, thank you
We'll
so much for the
factor
super chat,
that
my friend.
assessment into our decisions in an important way going forward.
Thank you for the peach. I appreciate it.
Thank you, for Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman.
Appreciate the support, brother.
I think I've heard you say a couple of times that you deferred
My
to
Solana
the
short
Vice Chair
profits.
for supervision. Do you think
I
that was
appreciate
the right way
that.
to go about
That was
this?
good.
And,
That was good.
yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, you know, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why. And, you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors. And really, in supervision, has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
OMG, I'm watching Chair Powell live on Tom Crown's channel, and he's cracking me up. I mean, I what is he saying?
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes.
Tom called Pepe.
Head count.
Congratulations.
In real time, but people did talk about pausing, but not so much at this meeting. You know that there's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there.
That's pretty funny.
Again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall.
Classic crime. Didn't want to betray
Marketplace.
Johnny
You
by
mentioned a
watching
few
Tom instead of
times about
live.
the lessons you learned from the banking
I appreciate
crisis,
that, Joe. I
you would
appreciate
learn
that.
the right lessons.
Unfortunately, I
What are
like
those
to just listen and see what's being said.
Yeah, I just would
I
start
don't
with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in
I see what
designing
he's doing.
the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Oh, I was just about to do it too. Damn it. That's basically what he's doing. I see. Great, now I gotta fix this. Shit. Not properties. That was bad timing. All right. Yeah. So that's it, guys. Did I mess up my crop settings? Hold on. I am watching it on my phone. So as like it is kind of funny. Yeah, you want to go ahead and watch it? Let's watch it quick.
Probably looking to return to, I don't know, a meaningless high here, sideways price action. It is what it is. You win some, you lose some, and a lot of the time though, you just have to look at the data. Remember, guys, this has been amazing. I want to thank Tom Powell for being here. I want to thank all of you for being here. Make sure you've liked, subscribed, joined the Discord, sign up with Femex or Fairdesk or MarketSite. The links in the video description below. I will be leaving tomorrow for NFT Talon in Estonia. I don't know how I'm going to make content while I'm there, but I'm going to figure something out for you guys. You know, I always think about you guys first. I love you all. Let's just end it on that positive note. I love you all. I will see you soon. Tom Powell.
Right. So pretty much, like, long story short, when it comes to my thoughts and opinions on what is going on or what Jerome Powell said, is the number one problem. This has always been the issue. The number one problem is that he makes these statements, you know, when he was talking about, let me lower my volume. He makes these statements that basically he's analyzing data that is old. All right. What I mean by that is a lot of the reports that he gets on his desk, or a lot of the reports that he, you know, discusses and talks about, is a couple months behind. So yes, things might be looking good from certain perspectives. You know, we talk about the unemployment rate. Unemployment rate's going lower, or unemployment rate is low while, you know, they're increasing interest rates. The problem with that is a lot of the data is lagging, right? A lot of the things are lagging. The information is lagging. They're pulling information from a couple months back. So we really won't know the true effects until months later. And basically what's going to happen is he's going to keep rolling out with these interest rate hikes, right? And then what's going to happen is the actual data itself is going to get worse. And so what is going to happen is he's just going to be persistent and keep going with these interest rate hikes and cause a snowball effect. Chirp Powell using lagging indicators. Exactly. Just like all indicators, they're lagging. So that's the number one problem, is that it's not going to be until a lot further down the line, until if we are going to see a positive result of what is going on, it's not going to be till much further. And so that's the number one problem with anything that always comes out of these meetings, is that the information that is presented from him, you know, to the public is lagging information. So petition to teach Chirpow ABC. Yeah, I signed that. That's good. But yeah, it's unfortunate, you know, guys, it's the same old, you know, same old jargon, mumbo jumbo BS. You know, we're just here to see how price reacts. You know, I'm still bearish. You guys know the drill. I just did a stream on David Tech's channel. So if you guys want to check that out, you know, I kind of go into more detail about, remember, not his main channel, his live channel. So if you type in David Tech Live on YouTube, you'll be able to pull that up. I just did a stream on his channel talking about my thoughts and analysis on what is going on. But, you know, pretty much same thing. I'm expecting lower, playing the game of probabilities here. So, you know, it's all the same. It's all the same stuff. All right. Wow, this is going on for almost an hour already. Jeez. He's got ADHD, focused on 2% inflation. Yeah, it's he's stuck in his ways. Is that ever gonna happen again? Probably not. And there's gonna be a situation where obviously you start leaving the machine on for too long, and you start raising interest rates, I don't know why I said machine, but you start raising interest rates too much for an extended period of time, and it's just gonna keep prolonging the issue. So we'll see what happens. It's not until wow, let me restart that. It's pretty much gonna be too late, you know, once the dominoes start falling. Now, guys, I talked about this in private, like with Kite and stuff. Like, you gotta understand, like, things might get bad, but if you guys ever think that we're gonna be bad to the point where we're gonna be bartering cigarettes and toilet paper like Venezuela, I'm sorry, like, that's not gonna be the case. Things might get tough, yes, absolutely. And I think long-term effects are gonna be, you know, things are probably gonna get bad, but the US is the number one, has the highest GDP in the entire world. We basically have the best economy in the world right now. And there's just no, I mean, obviously, if you live other parts outside of the US, maybe they might be a little different. I'm not trying to scare anyone, but I just don't think the hyperfixation of things being ultra bearish is healthy. They've been being ultra bullish. Don't know why I'm going on this tangent at this point. You guys already know the drill. But yeah. You guys have any questions? You want me to go over something while we're here? If not, I know it's off schedule. I don't want to go into too much, but just wanted to hang out, see what would happen. This one wasn't as exciting as the last one. The last one was more exciting. It was more fun. Next time, hopefully I can time it better so we can kind of actually stream and hang out a little bit longer. I know I started it literally right as Jerome Powell was speaking. So, but yeah, I'll give you guys a second. If not, I haven't eaten all day today. My eating window's coming up. Don't know what I'm gonna eat. I had wow, can't think of the 25 points. Yep, exactly, Mark. See, it's gonna be 25 points for a while. So, I had wow, what's the name of the fucking place? What the fuck? Panda Express. I had Panda Express yesterday for the first time in a little while. And Panda Express slaps, man. You get a bigger plate. You know, it's like 12, 11 bucks. It's like 11 bucks for a bigger plate. Smother some meat on there. Good rice. They have a chili sauce in there that's like spicy and sweet. Fantastic touch. I always slept on Panda Express. Panda Express. This is odd, but I was gifted an article on, I think, the top 3 early Pepe investors with their Etherscan wallets. Yeah, someone sent me that too. Who sent me that? Yeah, someone in my group sent me that as well. So I'll definitely be looking into that. Could be cool to see what they buy in a bull market. Yeah, I'll definitely be marking those out. I have the article here as well, Joe. Clap Show, what's up, man? You missed all the fun. You missed all the Jerome Powell fun. Panda is fire. So glad that you're expanding outside of malls. You can also sub rice for noodles for the veggies. I don't know why. Like I always like rice. I like the fried rice more. I don't know why. I just do. But I got the fried rice. Fuck. There's like 2 different types of chicken that I got. I've also tried the teriyaki chicken. Oh my god, it was so good. Like, I'm very utterly shocked by how good Panda Express Chinese food is. Especially for like budget. Pretty damn good. Clap Show, when dropped to 25K, lol. Well, you know the drill. As long as we're below 29.2. Next step is next logical. I mean, we have some supports. Like we have one at like 26.4. But if we can't hold that support, next probability is 19.5. So. Hype, hit the likes. Thank you guys. Thank you so much, Josh. And also, I guess I'll go ahead and if you guys want to go ahead and support me in the channel, just letting you guys know that the channel is being sponsored by Fairdesk. These streams are being sponsored by Fairdesk. So if you guys want to definitely go ahead and check out the first link in the description below. There are deposit bonuses. If you guys can meet those, that'd be fantastic. I know some of them are a little much to be fair, but remember, if you sign up, obviously with the whole Bybit stuff going on, countdown, we have 5 more days until Bybit is officially not allowing or actually going full KYC. If you guys are looking for a new exchange, I would appreciate if you guys go ahead and check out Fairdesk, as well as always be aware, regardless of what exchange that you use, be careful. Never only deposit what you need. Deposit more if needed. I've been using Bybit for the entire time I've been trading. Literally, like, maybe I had a demo account on BitMEX when I first started learning, but like my first actual account that I had money in was Bybit, and they've been absolutely fantastic the entire way. So, I'm gonna have to wait and see how these exchanges do, and before I can be more confident in putting more money in. I'm not saying you guys shouldn't, but just be careful. Just be careful. Let's see. So Panda started as a fine dining, sit-down Chinese place, but the Sun figured out they can do fast orders, and now are taking over. Joe, yeah, Panda is severely underrated. Severely underrated. How many pairs does Fairdesk have? I can show you. Did they give me a number? No, let me move my big head. Let's take a look. I mean, they have a lot. I have no idea what that number is, but they have the main ones: BTC, ETH, ADA, LTC, Tron, Doge, DOT, BNB, Sol, XRP, BCH, Algo, Atom, Near, Ethereum Classic, Sushi, Aave, XMR. They pretty much have all the same coins that Bybit has. They might not have much as a variety, but they even have look at this. Wow, why did I let go? There you go. They even have DYDX. You can trade DYDX. So definitely a lot of pairs. They have KDA. Oh, I don't think they have KDA actually. They don't. Damn. I didn't even think about that. But I mean, I haven't really been buying spot KDA on these exchanges. I did with Bybit, but I transferred out of it. But I just use Binance US as to kind of hold my spot bag. So unfortunately, they don't have KDA. Maybe I could talk to my representative and see if they can get KDA on there. I'm not sure. But unfortunately, they have most of the pairs that we trade. So yeah, if you guys check it out, would appreciate it. But yeah. Johnny, what's your mother's maiden name? Stop it, Joe. Stop it with the security questions. Her maiden name is Powell. All right, guys. If anyone doesn't have any questions, I didn't plan on doing a full stream today, but we're here. I appreciate you guys. Thank you guys so much. If you guys were here to watch Jerome Powell with me, I do appreciate it. I know a lot of you guys are stopping in after the fact, which is all good. We were just here to just watch price action. I will be here tomorrow, 1 p.m. EST. Like I said, unless something dramatically changes, I'll let you guys know. Good info from Jer Powell. He ain't gonna stop. Yep, that's unfortunate, but we power through. We keep on trucking. But until then, guys, I will see you guys tomorrow, 1 p.m. EST, 5 p.m. 6 p.m. UK, same time as usual. So I do appreciate you guys again from the bottom of my heart. If you guys want to support the channel, check out the links in the description below. Would greatly appreciate it. But until next time, be good, be safe, keep it between the digits. For some reason, that last part always makes me stutter. Brother, if you're in here, I'm sorry. More banks die, better BTC. Exactly. Thanks, brother. Have a good day, guys. All right. Thank you guys so much again. I'll be here tomorrow. We'll do an actual video, go over TA and stuff. Just wanted to hang out, have fun today. So until then, be good, be safe. We'll do the thing. Gonna hide behind. And last time I realized I didn't even say bye before I hit end stream. So I'm gonna go ahead and say bye this time. All right, let's do it. Bye-bye.